Welcome to OpalesqueTV. It's a sunny day in London. I'm together with Patrick Stutz, who just moved from Florida to open Bayshore Capital's London office, and the company is just about to launch a very interesting and attractive multi-manager debt fund. So Patrick is going to introduce himself, tell us also more about Bayshore Capital, and of course we're going to talk about this fund.
Bayshore Capital was launched in 2001 as the investment office for the Arthur family and friends. The family's head, Tom Arthur, was the owner of Tampa cigars, which was a manufacturer of non-premium cigars in the US. He sold the business in 1997, and that was on the heels of increasing government regulation of the tobacco industry, so more just legal pressure from the government. And therefore it was a good time to sell. Today Bayshore is run by Tom Arthur's daughter, Tracy Smith. She has co-managed the firm since 2001 with a partner beforehand. Then in 2012 took over leadership of the whole company and went out to really build out the institutional setup for Bayshore. Today we manage about $300 million for largely families and wealthy individuals. Our mandate is to find investments that are different and more compelling than what investors can get from your typical private bank or your typical asset manager or bank. And that's what we've really built our reputation on that effort. Today we have about 15 employees with offices headquartered in Tampa, and we recently opened the London office as well. I joined Bayshore in 2013. I'm Swiss. I was born in Switzerland. I started my career in Zurich in investment banking, and then pretty soon switched over to the allocator side and spent the last 13 years essentially as an allocator to a broad range of alternative strategies.
So Patrick, explain to us in more detail, what's your general investment approach?
There are four important elements that are ingrained in our process. The first one is have an open mind. The second one is increase your odds. The third one is remain nimble, and the fourth one is protect your downside. Let's go through these step by step. Have an open mind. It is absolutely our firm's approach to not be a specialist in a very specific area, but we think in order to become strong investors and be strong investors, we have to look at everything we see out there. And everything doesn't mean just across the board, but we think we need to have a look at all asset classes across the board, from very liquid traditional markets to the most esoteric, illiquid or private equity structures and everything in between. New markets, new approaches, only that will allow us to actually understand where risk is priced which way and what is an attractive investment or not. Once we find interesting areas, we have to do the work, and that's basically our edge. I mean, we know how to dig into a market and start to really understand it well, but I think we can only do this if you have a full picture. The second is that we try to increase our odds. We live in a complex world with a lot of uncertainties, and I think all of us investing have the feeling that we never understand enough about a certain area. So what we try to do is find these fast-flowing rivers in the investment industry and in the investment landscape that just increase our odds to be right. What we have is we have super themes that are multi-generational themes in the world, and many of the investors are aware of those. This could be demographic changes, this could be consumer changes, and we have to be very much aware of those, whether we're exposed to it or not, but we need to be aware of those. There are also structural changes that are more 5 to 10 year themes, like bank deleveraging, and we'll speak about this later on. But we have to be aware of those, and often we will try to get exposure to those themes. And then thirdly, the way you increase your odds is by just avoiding competition. This industry has become very, very competitive. Markets have become very, very competitive. We often try to find areas where competition is smaller and where we don't fight against an army of other investment managers, or where the managers we pick don't fight against an army of other managers. The third is remain nimble. We think small is beautiful. It is not easy these days to deploy capital if you're a $100 billion pension fund or insurance company. We like our size. We like to be a small firm. We like to be a small core team and then work with partners. And we also, in general, like smaller managers that don't have to deploy that much capital. The fourth is protect your downside. This is a humbling business. We've all, experienced that this is tougher than we think, and we've probably all been wrong more often than we would have liked to be. We always ask ourselves, what happens if I'm wrong? How can I protect myself against this? In this business, capital preservation is absolutely everything. Avoiding large losses is a big part of the success.
Private debt is a significant part of your business. So I wonder, please explain to us how you define private debt. Explain to us what's your universe there.
Private debt, in simple terms, is an agreement between a private borrower and a private lender. The private borrower, for some reason, can or doesn't want to tap the traditional funding markets. This could either be bank financing or it could be the high yield markets. The private lender is looking for a high yield substitute that he can de-risk in a proper way. What we end up with is a bilateral agreement between those two parties, in where the borrower as well can get a very structured solution for his needs. This can include flexibility with repayments, other call features, or it can include the loan amount that he needs as opposed to what he was offered by a bank financing, for example. The lender has free range to de-risk the credit. And this usually involves very large collateral packages, securities, and other features such as personal guarantees that he can secure to basically bring down his credit risk. In the end, we end up with a high-yielding paper that is attractive for both parties.
So tell us in more detail, how does private debt work for investors? What's the appeal of private debt for investors generally?
Private debt addresses many of the issues that investors have these days, and we're all well aware of them. There are generally low rates, low return expectations across the board in traditional and in some other alternative assets. There's also just a lack of safe assets that are out there for investors who seek a lot of downside protection. And then lastly, there's a big amount of mark-to-market risk out there right now. The reason why we like it is because it ticks a lot of the boxes for investments that we usually look for. There is the structural tailwind that I spoke about beforehand, with bank deleveraging being a main reason for the opportunities in private debt. The other one is there's a high demand for funding. Outside of the most pristine borrowers, a lot of entities and smaller companies across the world are struggling to get proper financing. The third is there's a narrow range of outcomes here. What I mentioned before, if we can increase our odds and increase our predictability in the outcome, we can definitely achieve that with private debt. The fourth is there's just not that much competition in private debt. Information is asymmetric. If you compare this to public markets, where all the information gets immediately disseminated and where all the pricing is available right away, private debt is a much more slow-moving market where you can have a real advantage if you're a skillful investor. And lastly, private debt is great for downside protection.
So Bayshore Capital has a history investing in private debt. Tell us more about that.
We started looking at private debt in 2007, but we didn't deploy first capital until 2009. We started with local opportunities in the US, in our neighborhood, where we saw opportunities in the real estate market in the tax lien space. 2 years later, we were first money in one of the world's first peer-to-peer lending funds. Since then, we have reviewed about 200 opportunities in the private debt space. We made 15 investments for about 125 million over the whole time period. In 2014, we launched our first multi-manager vehicle to provide our clients access to a diversified pool of private debt strategies. And in 2016, in a month, we're launching the second vintage of that strategy.
So you're launching your second private debt now. Is it different in any way from the first one?
Our Fund 1, which we launched in 2014, was structured as a closed-end vehicle. It had a pretty narrow range of strategies that we allowed for that strategy. We required 100% of returns being distributed on a quarterly basis. We also required absolutely no mark-to-market risk. The fund was raised and closed and has been returning about 8% since launch. Fund 2 is structured differently. It is an open-ended vehicle that has a higher return target. We also opened up the box of investable strategies slightly. We allow for more mark-to-market risk, and we are not as strict in regards to income distribution. Fund 2 has a return expectations that is slightly higher than Fund 1. We're talking 9 to 10% net to investors. We're going to launch with 3 managers and increase that number very quickly to 4 managers. The initial exposures we have are with an Asian direct lender, we have a global commodity trade finance fund, and we have a UK specialized lender in the real estate space. Given that it's an open-ended structure, we will focus our investments on other open-ended structures or short-duration closed-end funds. What this means is that the capacity for the fund is limited. We think we can deploy about 250 million and then we will hard close the fund. This will give us ample of opportunity to build a portfolio of about 6 to 8 interesting strategies. And what it also allows us is to provide our investors with an ongoing option for liquidity. If they need to redeem out of the fund, they can do this on every second anniversary of their investment. This allows us to build an attractive portfolio that is focused on the shorter duration end of the private debt markets, and it allows our investors to not have to commit for 7 or 9 years to the asset class.
What other opportunities are you now targeting with your second debt fund?
We break out private debt in 6 sub-areas. If you look at the big institutional flows into the asset class, they are mostly going into what we call the mainstream strategies. This is your classic mid-market lender, distressed, and your mezzanine strategies. We think about 5% of the flows only are going into what we call the niche strategies, and that is really where we focus on. We break out the niche strategies as follows. As you can see from the slides, the 6 areas start with direct levered lending. This is your typical mature funding market for debt to corporations with high financial leverage. The key ratio is debt to EBITDA, and often these transactions happen in conjunction with private equity sponsors. The second area is asset-based lending. This involves a line of credit or a term loan based on the value and liquidity of collateral. And the key metric is loan to value. The third area, specialty finance. This is where it gets a bit more complex. Structured transactions of increased complexity, balance sheet facilities, risk transfer transactions, factoring, leasing, complex or niche collateral transactions. The fourth area is probably most understood by private debt investors. It's trade finance, which typically involves short-term loans to finance international trade. The fifth area is marketplace lending, the technology-supported small balance lending to mostly unsecured borrowers. Marketplace lending has undergone a rough patch after a period of very rapid growth, but we think it will be part of the direct lending universe going forward. The sixth and final area are asset transfers, which typically involves secondary market purchases of private loans, both performing and non-performing. Often these sales come from bank balance sheets.
Patrick, what's your outlook for private debt?
Unless we go back to pre-crisis areas where banks were lending and interest rates were higher, we think that the only way for private debt is to further grow. Lending markets are disrupted. Only the most pristine borrowers can tap the low rates that are out there in the market. On the other hand, a lot of capital has been deployed in the space. And I think the big concern of investors is that they want to see the asset class go through a crisis. We actually think that private debt will come out of the next crisis in pretty good shape. And that's probably when really the second stage of the growth phase will happen. In the short term, in a world of low interest rates and the lack of opportunities, we think that private debt is by far the most attractive asset class out there.